What's up, everybody? Welcome back to J&J Futures. Today we're talking about top-down analysis with fair value gaps. All right, so with top-down analysis, you go to the top. That's like 4 hour, 1 hour, 15-minute. And then on the bottom, we have the inverse entries like, 3, 5, 1, 2. So top-down analysis is just the process of going from, the highest and most powerful time frames down to the bottom to make sure that everything aligns for a trade. So for example, you go to the 4 hour and you'd be like, okay, we're respecting a bullish fair value gap, so we're probably going to go up. Or in Jake's case, Jake has one on the screen that he's going to break down right now.
Okay. Here's a fair value gap that I'm about to break down that Jack said. So right here, we have a bearish fair value gap. This is a 4-hour time frame. So when we're doing this, this is how we form our kind of daily bias. So we go to the 4-hour, marked out. So we see a bearish fair value gap, mark it out, draw a little fair value gap box. So say this price didn't exist in today's, I think it's Wednesday. This is where, today's Wednesday, and we just inverse this huge 4-hour. So I would be thinking my first initial reaction is that we're bullish. So I'd go down to the 1 hour. I'll check to see what does price look like. So we inverse. Is there any more 1 hour fair value gaps that we need to inverse? No. Okay. So I don't really see any indication here. There's no fair value gaps. See, there's wicks all over the place. Nothing. We did form a bullish fair value gap inside the bearish 4 hour. So I'd mark that out. And you go to the 15-minute. And you look for any other indications. So right here, so we see that we inverse. So firstly, we inverse the 4 hour to the top side or to the upside. So now we're thinking bullish. Now we formed another bullish fair value gap on the 1 hour. We see that price goes up and respects it. So now there's double confirmation that we're bullish. Then we look for any other 15-minute fair value gaps and then any lower time frame fair value gaps to enter a trade.
So you may be like, what does this really mean? So I guess the best way to explain this is the highest time frames are showing the biggest picture because they have the most data collected. AKA, the highest time frames have the most time in each candle. So when you go on the higher time frames, you know more about the bigger picture in the market and what has happened recently. So when you make a fair value gap from a higher time frame like the 4 hour, the 1 hour, you're using data over multiple hours. And that is so that you have the direction for the next couple hours. Then that's why we enter on the smaller time frames, after doing our top-down analysis, making sure there's nothing else in the way. That's why you enter on the smaller time frames, like the 1 minute or the 2 minute or the 3 minute, because that's how you get the direction for right now, for the next couple minutes. So basically, every single entry on every single time frame will usually go for that amount of time. The 4 hour fair value gap getting respected means that we'll probably, for a couple hours, maybe 4 hours or more, keep going in that direction. Then the entry on the lower time frame, maybe the 1 minute, means that we might keep going for 1 or 2 or 3 minutes.
So when you're doing top-down analysis, one thing that you need to be cognizant of is the higher time frame fair value gaps. So when you're looking at fair value gaps, the highest time frame holds the most power. So say you find a 3-minute fair value gap. If there's another higher time frame fair value gap, not a 1 hour or 4 hour, but like a 5-minute fair value gap that's either in the 3-minute or above it, you need to be taking a trade off the highest time frame. So right here, there's a 3-minute fair value gap. We see that it gets inversed eventually, but say like price action was live and you're looking at this, you're waiting for it to get inversed. You need to go down to every time frame, so the 1, 2, 3, 5, up to the 15-minute, and see if there's another fair value gap in this range. Right here, there's a 3. You'd go to the 5. We find New York AM, so right here, and we would check to see if there's a higher time frame fair value gap. So as you can see, here's a 3-minute that we drew out right here, and we can see that there's another 5-minute that formed inside of it. You would need to take a trade off the 5-minute fair value gap. You would not take a trade off a 3-minute. But if there's a 3-minute and there's no higher time frame, then the fair value gap's good to go and you can take a trade off it. But if there is a higher time frame, you cannot use a lower time frame to take a trade. This is crucial when using inverse fair value gaps. If you do this, you will lose trades. So because this is kind of a hard concept to grasp at first, just like a quick rundown on how to use this again. So when you're looking for a daily bias, just mark out a 4 hour or 1 hour, the closest one you see to live price action. And then once you kind of form to see if, or you form a bias. So you see if its price action is respecting either a 4 hour or 1 hour fair value gap, you can go into a smaller time frame. So once that's out of the way, the 1 hour and 4 hour, you just don't need to use that anymore because it's going to be a little complicated for beginners. So you're going to strictly use the 15, 5, 3, 2, and 1. And if you don't have trading view premium, you're not going to have 2. So just use 1, 3, and 5. And when you take a trade using inverses, you're only going to use the 1, 3, and 5. So like I said, the highest time frame fair value gap holds the most power. So you're going to look for 15s first. If there's no 15s, then you can go down to the 5s, and the 5 is going to hold the highest time frame power. So this is a really important concept, but you just need to understand that don't like when I'm referencing a small time frame fair value gap, so 1, 3, 5, and 15. I'm not referencing the 1 hour or 4 hour because it's gonna look weird. Like it's gonna be a little weird when you're marking out every single fair value gap you see on your screen. So just mark out a 1 and 4 hour to determine a bias. So think, is price going up or down? And once you got that out of the way, you can either keep those fair value gaps or delete them. So if I use the 1 hour and 4 and I see prices going up, delete those fair value gaps. You know price is going up. Then go down to the 15, 5, 3, and 1, and then draw your fair value gaps that you see and kind of see if off those fair value gaps or if it's inversing those fair value gaps, and then you can kind of continue on with your model or our model.
So yeah, just to conclude, top-down analysis is super important because you could catch a higher time or lower time frame fair value gap interfering with one another. So using our strategy and using top-down analysis to find direction, and then higher time frame direction, lower time frame for entries is very key to getting a really good trade and some consistent trading over time.